Welcome to Market Monday from the investment team in the trust department at the First National Bank. We're closed today for a holiday, but there are a lot of important data points coming out on the economy over the next couple of weeks, and we wanted to keep everybody informed. So starting off, we get information on producer prices through the PPI, which is the Producer Price Index, tomorrow. That's expected to come in at a 0.2% growth month over month and a 7.3% growth year over year. Later in the day, we'll get the Federal Open Market Committee meeting minutes, and that tells us the level of cohesion on that committee as to, their stance on inflation and how aggressive they need to be going forward. Are there any dissenters who are starting to see signs that inflation is topped out and they can take their foot off the gas? That's what the markets are going to be looking for. We get information on consumer prices the following day. That's expected to have grown by 0.2% on a month-over-month basis and 8.1% on a year-over-year basis. Again, these numbers are very strong, and we think it's far too early to declare that we're out of the woods with inflation or we've seen quote-unquote peak inflation, as some analysts have been trumpeting. You get labor market conditions later in the week, and then what's happening with the consumer. Are they continuing to spend? Retail sales is expected to come in at a 0.2% growth. And the sentiment indicator, the general business climate out there. That's important because the consumer represents more than 2/3 of our GDP growth. Moving into next week, we get information about manufacturing, labor market again, the housing market, and we get our leading economic indicator index, which is an aggregate of several economic indicators that together have some predictive power as to what's going on in the economy. That's expected to come in at negative 0.2%. What's going on in bonds? Well, this is one of the most attractive times for fixed income investors that we've seen in a very long time. One-year rates are now 4.57% in A-rated bonds. That started the year off at 0.57. 5-year paper, we can even get over 5% now, where we were only getting 1 2/3 at the beginning of the year. So income investors are doing quite well. Equity investors, on the other hand, have seen approximately 18% of a decline year to date in the market, and that could be frightening. This is where we want to stop and pause and think about things for a minute, because as long-term investors, what happens in any given 1 year isn't the most important thing. And I know that investors are getting nervous down in this area. We have to pull back to a longer term time frame, which coincidentally is what we've advocated for and what we invest for. And over that longer term time frame, that's a lot less intimidating of a picture. And we need to maintain in a long-term investment plan that's designed to operate over long-term market cycles. We need to be less concerned with the day-to-day movements of stocks or the shorter-term movement with stocks and see what the overall trend is. And for now, our advice is continue to hold on to your long-term investment plans, which were put together, with this in mind and with the understanding that there would be periods like now of market volatility, and continue to do that throughout and hold for the longer term. Now, in the short term, if you're having questions and you're worried about the markets and you're stressing out about the economy, let us know. Give us a call, and we're here to talk about that stuff. Hopefully you found this information useful. Thanks and have a great day.